Hi, today I want to talk to you about annuities. This is an investment vehicle that we have grown to look disfavorably on over the years. It's one of our least favorite investment vehicles for a number of reasons, and I want to address those today. First, in the industry, it's sort of a joke that annuities are a vehicle that is sold, not bought. What does this mean? Well, what this means is if you're an investor or an advisor on behalf of an investor, considering all the vast realm of investment options for money based on what you want those funds to do for you, you might consider stocks, bonds, preferred stocks, mutual funds, index shares. The last thing you probably would decide upon might be the annuity. But in fact, that's not how most annuities are purchased by investors. Most annuities are purchased directly from an advisor who is actively promoting and selling them. They are sold. And there might be some reasons for this from the advisor, and we will get to those a little bit later. But that's commonly thought that annuities are sold to the investment public. They're not purchased by the investment public. Second reason, and perhaps an even bigger reason, is that they're just expensive. There's a number of layers of fees in annuities. The first fee that you need to be aware of is called the mortality and expense fee, the M&E fee. Generally, that's going to be about 1 to 1.25% of your assets in the annuity every year. So as your assets grow, of course, that's going to grow too. And that's a direct fee from the insurance company itself. And then a lot of annuities are sold to protect investors from dreaded scenarios like the stock market or big downdrafts. And so they've got additional features in there, guarantees, income riders, things like this. And those may add another layer of fees that are called riders. So a lot of these additional guarantees come with their own expense on top of the M&E, and a rider can easily run to 0.75%. And then, of course, inside the annuity as well, you do have an investment vehicle choice usually, and those investment vehicles have internal expense fees as well. So, and they might run to 1 to 1.25. On the low side, it might be 0.8. I've seen them. On the high side for an international small cap fund, could be over 2%. So, when you start adding up the M&E fee and the riders and the expense ratio, you're going to see that easily you're over 2% for most all annuities every year, year in, year out. And not infrequently, you can be up to close to 3% with fees. So fees are one of the features that we dislike the most. Now, having said that, unless you're asking the right questions, you're probably not going to become aware of all these fees. So that's one of the reasons we're putting this together. Another item is that most annuities are sold. The prime time to sell them, in fact, is when the markets just take a hammering and when everyone's scared and nervous about that because they play to your fears by stressing all the guarantees and features that the annuity is going to provide you with. These guarantees are provided based upon actuarial studies. So second only to rocket scientists in terms of intelligence are the actuaries, young men and women or old men and women, whatever it may be, that work for the insurance companies. Actuaries are very smart people. And what they do is they calculate out all the range of scenarios that could happen to the holder of this investment vehicle, this annuity, that could then cost the insurance company money, and they price it accordingly. So suffice it to say that for the investing public to win in mass, the actuaries have got to be wrong, and they're not wrong very frequently. So another reason we don't like annuities is that the actual dreaded scenarios that the annuity protects you from or pretends to protect you from diminish over time anyway. So let's talk about 2008, which is the year the market was down 37%. And most people who bought annuities have cited, a drop in the stock market as one of the reasons they bought this to get some guarantees. Well, that exact type of scenario diminishes over time anyway. So unless you're trying to protect money that you need within a year or two, that reason really doesn't hold too much water with me. And let's just consider some real numbers, for example. One of my favorite investment vehicles to recommend to clients is a passive index fund called the iShare Mid-Cap Index, and the symbol in that is IJH. It is an index that represents 400 different companies that are all mid-caps out in the stock market, and these are decent-sized companies. This iShare IJH has been a great vehicle over time. If you bought that iShare, though, unfortunately, at the peak of the market in 2007, before the market tanked, sitting here in early 2014, you are up 42%. So you bought that iShare right before the market tanked. It was the most unfortunate time to put money in the market, and you're still up 42% after riding out a 3 standard deviation negative move in the stock market. So don't protect yourself from something you won't need for another 30 some years. Now, if you were fortunate enough to buy that iShare at the market's trough when the market was down, instead of running to a foxhole and putting your money in cash or in a mattress, then you're up 235%. 235%. That's a pretty darn good return during that period of time. So time itself diminishes the need for these annuities and the reason that most of these annuities are purchased by people. And then a final reason we don't like annuities is annuities generally have large commissions in them. Sometimes in the neighborhood of 4 to 5% is not uncommon at all for an annuity to pay the advisor. And what might be less common is that the advisor lets the investing public know that right up front. Now, again, I have friends that sell annuities. I have sold annuities in the past. There might be some valid reasons for this, but they're not our investment vehicle of choice, and we hope the advisor is not being clouded in his or her decision making by the yield to broker per se. So, and a final thing I want to say about annuities is one of the reasons that most investment advisors get fired up about annuities is that all of the insurance companies that sell annuities have wholesalers that call on us as advisors. Especially they call on the big firms. They'll go into, at my former firms, they would come in and buy us lunch once, twice a week and tell us all the wonderful features of their annuity. Oftentimes what you'd find after those meetings is the advisors themselves never truly understood all the bells and whistles attached to these annuities. They're just, as one of my good friends said, they're smoke and mirrors. The wholesalers are second only in importance to the insurance company behind the actuaries. But so the process often goes from the wholesaler to the advisor and then to the investor. So it's not a relationship in that scenario where the advisor is really sitting on the same side of the table as the client, helping them choose from a broad range of investments. So those are our feelings on annuities. I thought I'd get this out to you as a way of informing you a little bit. If you have any questions on any of this, I was going through this rather quickly, so feel free to give us a call or contact us here at braeburnwealth.com.